Hey guys, it's Richard with Matthews Wealth Management, and by popular demand, the red pants are back. So in today's video, we're going to be covering net unrealized appreciation. That's a way out there term, but it's a strategy that is extremely valuable to those of you out there with 401ks and ESOPs who own company stock through your retirement plan. So we're going to talk about a hypothetical example, but really this is a tax term. So the terminology is talking about the appreciation on values of stock that has yet to be realized, meaning taxable. So we're going to talk about a strategy where we can take advantage of some rules where we can convert through income tax and capital gains tax. So let's just go through it. It's going to make a whole lot of sense by the time we're finished here, but in our example, I want to lay out a few assumptions. The client that we're going to work with in this scenario here, let's say age 55. And obviously we're going to aim for the retirement age of 65. So that's kind of our working time frame here. So retirement 65. All right, so I could really fill up this board with a lot of information that would kind of be not really central to the point here. So all we're going to talk about in this example is the portion of the 401k that is invested in company stock. So let's keep those numbers very simple here. And we're going to say that the stock value currently is at 100,000. Okay. Now there's another very important term that we need to factor into these calculations, and I've done a number of these over my career, and typically it does take some time to figure out what this number is. It's called cost basis, and what that means is how much over the years of contributing into your retirement plan did you pay into the actual shares of stock that you own in your company. So the best way to work with that is to go to HR and have a phone call and ask them to track down the average cost basis for the shares inside of your retirement plan. Typically takes a week or two. I've had a couple of companies lately with some custodians that are they're on top of it, and they can tell you over the phone what the cost basis is. But in our example here, we've called HR and they've told us the cost basis on these shares is a nice round 25,000. So we've got cost basis, and we're going to go with 25,000. So if we want to get particular and throw some terminology around right now, that $75,000 there is unrealized appreciation. So now we're going to talk about, on this scenario, how we can actually take advantage of some tax rules to make sure that we can minimize our long-term tax on this situation. So we've got a 10-year time frame. I'm going to use an average rate of return here. Let's say 8% is what we're going to use for the growth of this stock over the 10 years here. Whether we're in the 401k, whether we're out of the 401k, that'll make sense in a bit. So got my cheat sheet here so I don't have to calculate on the fly. But in this scenario, we've got the difference here. $75,000 is our unrealized appreciation. If we go with the net unrealized appreciation strategy, what we will actually do, in fact, is take these shares of stock out of the 401k. Okay, now we're not going to necessarily roll it over to an IRA like we typically would with a 401k with the pre-tax dollars. In this instance, the strategy involves taking those shares of stock out and putting them into an individual non-qualified account. And if you check some of the other videos out there, non-qualified means not pre-tax dollars. Okay, so what that means is on this $25,000 of what we paid into it, remember we didn't pay taxes as we contribute into our 401k. So now's the time. We got to pay taxes on this $25,000. Okay, so I'm going to write that up here. We've got 25 that's going to be considered taxable. And I want to use, in this scenario, let's say that our client is in a 24% tax bracket, or marginal tax rate, but that's going to be the tax that we're going to apply to this $25,000, which is pretty good. So that's $6,000. So that $6,000 is either going to come out of our pocket, a savings account, a checking account, something like that, or we can actually take it out of the value of the stock and pay some additional tax to do that. It's best to use this strategy if you do have some cash on the sidelines to cover this tax here. So we've got the $6,000 here on the side to cover it for the $25,000 that we have to pay taxes on, but the value of the stock is still at $100,000. Okay, so if you look at our financial calculator series, you can figure out how to run the future value of how this $100,000 grows over these 10 years at an 8%. So we're not going to go through that here, but if we go from $100,000 for 10 years at 8%, no payments obviously, that puts us at a end value of $215,892, and that's going to be a future value, okay, of what our stock is worth at retirement. So we're not talking about reinvesting or diversifying or better risk reward balance. We're just talking taxes in this scenario, okay? So we're going to assume that we hold it for that 10 years. Now we've got $215,000 at retirement in this stock. So you can see we've grown an additional capital gain at this point because it's in a different type of account. We have a capital gain of $115,892. That's a capital gain. Now, the other piece of the puzzle here, if we come back to the other side, the $75,000 gap here, the original unrealized appreciation, we need to add that in as well. So in the world of capital gain, we actually have, it's 3 different rates, and it depends on your income level. In our example here, we're going to use a 15% long-term capital gains rate. So on the $115,892, that comes out to a tax that is owed of $17,384. It's just going to be on this last 10 years of holding it after we've implemented the strategy of net unrealized appreciation. At that same time, we have to look at our original $75,000 and pay our capital gain on that as well, and that's also 15% in our example, and that number comes out to $11,250. So let's go ahead and add those two together, and that gives us a total tax in this strategy of $28,634. And then you remember the $6,000 we paid originally? Let's go ahead and add those two together, and it gives us a grand total for the entire 10-year strategy of $34,634. So this is actually a solution to pay the 17, the 11, and the 6 to equal a total of $34,000. The flip side of this strategy is that we just let this stay inside of a 401k. And then when it comes time to retire, the same rate of return and so forth, we're now going to pay income taxes on the total balance at the time of $215,000. So let's look what most people who are unaware of this strategy, what they would typically pay in terms of taxes for comparison. So if we take this $215,892, and remember we're at a 24% tax rate, a tax bracket based on the fact that we are just the income levels for this client. That number comes out to $51,814. So we've got 51 versus 34. So that's $17,000 of savings, roughly a third of savings that we got to keep, that we didn't have to pay in taxes. It had nothing to do with investing it differently. It did require us to have a little bit up front, but we factored this part of the cost into our 34. So if you do have some company stock inside of a 401k, it's worthwhile to look at what is the cost basis. The calculation here and how much is due at the time of implementing the strategy dictates how successful it's going to be, but this is a very common scenario for people that have some shares of stock in their 401k. So if you need some help calculating this, don't hesitate to reach out. We'll walk you through it. But hope this has been helpful. It's a very complex terminology, and the behind the scenes with the paperwork is important, but definitely worth saving a good chunk of change if you do it right. So join us next time. We'll see you then.